The U.S. Central Bank has raised interest rates another 1/4 percentage point, apparently confident that it would help tackle inflation but not put additional pressure on banks. This came after a week-long, nerve-rattling banking crisis that saw two major mid-sized banks fail.
Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound.
Powell said the latest banking shakiness will result in tighter credit conditions for households and businesses. The Fed's latest interest rate hike alone will raise the cost of borrowing and the interest borrowers pay on credit cards. The Fed has been raising interest rates 9 times in a row since last March in an effort to get inflation under control. U.S. inflation stands at 6%, down from a high of 9.1% last June.
Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
But using interest rate hikes to lower inflation has been complicated by those two bank failures, although Powell called one of those failures an outlier.
So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. These are not weaknesses that are at all broadly through the banking system.
Powell suggested the Fed might pause interest rate hikes at their next meeting in May, but he didn't talk about cutting interest rates. Investors on Wall Street were not too happy about that, and stocks nosedived 530 points. Andy Roesgen, TRT World, Washington.